My name's Kyle Burns, president here at the Raccoon Group. And today we're very excited to welcome you all to what should be what I think is a very exciting topic. And we're going to talk about fixed income and what's coming ahead. And so we're really fortunate today. Today we're going to be joined by Joyce Huang, who you can see on the screen here. And Joyce is with American Century, and she is a portfolio manager on their multi-sector funds. I'm sure maybe she'll tell us a little bit more what that means for everyone's context. But we were just talking a little bit before and thinking about Joyce's road to this point. And so her fun fact, which I find very interesting, is that Joyce was lucky enough, we'll call it, to work at Lehman Brothers in her first job, and she happened to be working there in 2008 during what was a major collapse in the markets at that time. And so I'm sure that experience has helped you kind of leverage your career throughout, and it's probably a good learning experience. So with that, I'll let you, Joyce, introduce yourself and maybe a little bit about American Century, and we can take it from there.
Yeah, thank you, Kyle. Thanks for having me, and thanks everyone for joining us this afternoon. So I have spent my whole career in fixed income, so I am also very excited to talk about what's going on in the bond market. Especially given the market volatility we've seen so far in 2025, it is very interesting that, even today, I saw some headlines that basically were saying, as the tax bill's making its way through Congress, that the bond market is really starting to protest again. And everyone knows that we had an equity market sell-off in April. It lasted just a few short weeks, but the bond market is starting to react a little bit more to the fiscal situation. So definitely a lot of headlines going on with fixed income. As Kyle mentioned, I started my career in the industry prior to 2008 at Lehman Brothers, and I think the thing I love about fixed income so much and why I've continued to seek new roles in this asset class is just that there's so many things that are changing every day. So as a fixed income investor, we do all the things that equity investors do, but we also have to consider a lot of the macro environment. So interest rates are a big driver of fixed income returns. And what drives interest rates? I mean, pretty much anything, right? So that's why being in fixed income means you just really have to be on top of everything. Like, I'm constantly checking news articles, different data releases. Like we had some jobs numbers coming out recently. So always checking on what's happening. So hopefully today I can share with you the key takeaways from our outlook and where we're seeing some opportunities in fixed income. Let me go ahead and share my screen. Oh, there we go. So in summary, these are three key factors we look at that really determines our macroeconomic view at American Century. So the three key things that affect fixed income investments are inflation, monetary policy, or what the Federal Reserve is doing in the United States, and interest rates. So both of those two factors feed into the interest rates at the end. So inflation. I mean, I don't have to tell you guys, but every time I go to the grocery store, I'm definitely still a little bit shocked at the prices, right? So luckily, last time I bought eggs over the weekend, I was able to get 2 dozen at Costco for about $6. So I think that's a pretty good deal. We've seen inflation slow considerably. However, even with the last reading from April, it's still above the Fed's target of 2%. Those of you who have been investing for quite a while know that post 08 and pre-COVID, there was actually a period where we couldn't get to 2% inflation. Remember when we were concerned that inflation was too low? Well, now we have a problem that it seems kind of stuck above 2%. And one thing I caution people to think about is while the last few inflation numbers were pretty mild, it doesn't really fully incorporate the effects of any new tariffs that are going to be coming out. We don't know what the final slate of tariffs are going to look like. We don't know what the deportation situation could be and how that is going to affect the workforce. We don't know about how Doge is going to work with Elon Musk leaving and what the plans are for streamlining the federal government. And of course, onshoring, right? So, all of these things could cause inflation to turn a bit higher in the second half of this year compared to the recent softening trend in inflation. So, just one thing to keep an eye out for. A lot of people always ask me, what are the top few things I can watch for to think about what's going to happen in the market? And I would say inflation is definitely one of those things to keep an eye on. And the CPI, or the Consumer Price Index report, is released monthly on a 1 month lag. So you can keep an eye on that every month. Monetary policy. So, for a while, I think if you ask the average person who the chairman of the Federal Reserve is, they would have no idea. But, Jerome Powell has really taken a front seat in everything that's been happening during COVID, where he had to do emergency rate cuts to zero to save the economy from diving into a deep recession. He implemented some new tools that the Federal Reserve has never used before, such as purchasing corporate bonds, both investment grade and high yield, to provide liquidity to those markets. And now, of course, he is under fire from President Trump, who believes that interest rates should be lower. And Jerome Powell has been on a rate cut pause for 2025. So they've been at odds, and President Trump has been very vocal about putting Jerome Powell on the spot to further cut rates. So he is definitely in a tough spot. So I prepared these slides a week or two ago, and at that point, we did believe the Fed was going to cut 3 to 4 times in the back half of the year. Now that it seems like we've reached some tentative agreements on the tariff front, avoiding the worst case scenarios that we were afraid of, I would probably say 2 to 3 is more the right speed now. Because, to point one, inflation does remain a little bit elevated and could go higher with the tariff effects that we don't know about yet. So the Fed is very likely to remain slow and cautious, and they will probably cut rates once we see more of an effect take hold in the unemployment rate and things like that. So if that significantly worsens, we would probably expect more rate cuts than fewer. However, the key takeaway I want to leave you with today is that we believe interest rates are very attractive right now. So there isn't a lot of risk in terms of credit risk in the market at the moment. We don't anticipate the US entering a deep recession. And so we see a lot of opportunities to capture attractive yields in fixed income. People are always surprised to hear that prior to COVID, you were getting lower yields in high yield bonds or junk bonds than you're getting for high quality investment grade bonds now. So, because yields have risen so much, you are getting that premium to be investing in fixed income. And again, you have to go back to pre 08 to see the same level of interest rates that we have today. So it is a really good opportunity to look at opportunities in bonds. So here's a chart that just shows what's going on with GDP growth and where it could go and the way it moved during that shock in April when we had the full slate of preliminary tariffs rolled out. So the green line is the actual GDP readings. You can see that the consensus was the dotted line. So it was kind of moving downwards. And on average, 2 to 2.5% is the average rate at which the US economy tends to grow. So We know that we had very strong GDP growth over the course of the last year, but it was starting to slow. The consensus prior to the release of the tariffs was that it would continue to slow a little bit back down to that 2% long term average. The effect immediately following the tariff announcement was a sudden drop of over 1% down to 1.26% GDP growth for this year. Now, even and the reason why I say that we don't believe there's going to be a severe recession is that this was probably the worst case scenario that we could have forecasted in terms of the severity of the tariff implementation. So, in that case, even in that scenario, you don't see GDP growth falling off a cliff. And even though it declined significantly, it recovered. So, in looking forward 1 year, regardless of the scenario relating to the tariffs, you can see that it really converges back to the 2% average by March of 2026. So that is one very reassuring point. Now, thinking about opportunities outside the US as well, right? So we know that US exceptionalism has been the focus of the market, especially on the equity side, right? With the Mag 7 and everything, and the rapid growth that we saw from 2022 up until the beginning of this year. US exceptionalism has dominated financial market returns. However, when you look at the right hand side of the chart, one thing that's shocking, especially for those who remember Japan's lost decades, Japan is actually the fastest growing developed market country that we are projecting for this year, followed by the US and the UK and Germany and France. But all countries are really starting to accelerate. And we've seen Germany come out from a near recession to generate quite positive growth trends. And that's kind of spurred by the fiscal spending, the military spending that they've been putting forth, dealing with the Russia Ukraine situation. So, again, we have seen non US equities rally with the increased growth projections coming from non US countries in Europe. And so it's just a good thing to consider that the US exceptionalism story, I think it's too early to say that that story is over, but the nice thing is that diversification is paying off on both the equity and fixed income side because you're starting to see more growth outside the US, and central banks outside the US are cutting rates more quickly than the Federal Reserve is here. Now, of course, inflation, again, we touched on this, is that inflation, while it's way down from the peaks, it's definitely still above the 2% level. And headline CPI is that number that kind of comes out that includes all the components of inflation. Core CPI is a metric that takes out the most volatile parts of inflation, and that would be food and energy. We know that energy prices are very volatile as well as food, so it's not really accurate or reliable to look at inflation month over month, including those factors, because you can have big swings in food and energy prices. So core CPI is headline CPI minus food and energy. So you can see, even if we take those out, it's still running above 2%. And in fact, it's actually higher than headline CPI. Headline CPI has been lower recently because energy prices have fallen a bit. Now, the right-hand side of this chart is a even newer metric called super core CPI. So super core CPI is taking core CPI and subtracting shelter. So I think it's kind of a funny metric because, first of all, it doesn't really help the Fed make its point that inflation is under control, because super core inflation is actually higher than core CPI. And, when I think about my own budget, once I take my paycheck and subtract housing, food, and energy, I'm not really left with a lot. So, I guess if you don't have a lot left over, there's not much inflation to be spoken of. But I think it's kind of a funny metric. But I wanted to show it just because it is a term that gets tossed around a lot in terms of looking for different ways to evaluate the true inflation situation here in the US. Now, this is something that I think is very interesting where we look at what's happening with trade wars and the economic uncertainty. I've talked to a lot of analysts and uh, analysts from companies and even within American Century, and the consensus really is that, fine, if like let's just get it over with, right? The uncertainty is what is causing the volatility in the market. Like if we were really to just implement the tariffs as they were announced on Liberation Day, okay, that would have been not great in terms of the immediate effect, but at least we would know what it is and we could, adjust our plans and our hiring plans and our manufacturing strategy to accommodate that. Now that we're in the 90-day pause and there seems to be different agreements being made with different countries, it's very hard for companies to be able to plan ahead. And you see that expressed in the CEO confidence index, right? So it's basically lower now than it was during the rapid rate hike period in 2022. And you can see that there was a drop during the initial onset of COVID in 2020. But again, you haven't seen it this low in over 10 years. So that just speaks to the uncertainty of this market environment. We've wrapped up the first quarter earnings season. I mean, the number of times uncertainty was mentioned in these calls was staggering. Many companies actually pulled guidance for second quarter earnings because it's just too hard to project if you don't know what the impact of the tariff situation is going to be on your earnings for the rest of this year. On the left-hand side, we're looking at consumer confidence. And again, this is really critical to the future of US growth because consumers drive 2/3 of GDP growth. So why has the US done so well relative to other countries? It's because US consumers love to spend money and they've been bolstering the economy through, the post-COVID revenge spending, revenge travel. I think I read a statistic that said, US tourists going on vacation to Italy represent like 0.5% of Italian GDP just from American tourists coming on vacation. It certainly feels like last summer I was the only person who did not make it to Europe for a summer getaway. But you can see now, after really hitting a short-term peak since the rate hikes of 2022 last year, consumer confidence has fallen very, very rapidly. And again, is also at the lowest point it's been at for the last 10 years. We're also seeing some signs that some consumers are facing significant headwinds. And of course, we do have to differentiate between different tiers of consumers or the American people, right? So we have the bottom 50% and the top 50%. The bottom 50% have been experiencing financial stress for some time. Hourly wage workers were the ones who were mostly benefiting from the competition for labor post-COVID. And that's the demographic that we saw the biggest gains in wages over the early 2020s. However, since then, we've seen a flat line in wage growth for hourly workers. And as we know, inflation has surged, which has further eroded their purchasing power. So you can see I drew a line in this chart to indicate when the Federal Reserve started hiking interest rates in 2022. There's a pretty obvious change in inflection from loan delinquencies starting to rise. So the dark green line is credit card delinquencies. Um, right now, we are facing almost 12% of people are 60 plus, 90 plus days delinquent on their credit cards. That is higher now than it was during COVID when many people were out of a job. So that is very concerning to us. The yellow line is auto loans. So that is basically close to the pandemic peak as well, with almost 5% of auto loans being delinquent. Now you say 5%, like that's not quite as worrisome, let's say, as 12 even, but I almost feel like the auto loans being delinquent is even more telltale as to the state of the consumer, because in most parts of this country, you need a car to get to work, to earn a paycheck, to pay your bills. So you're going to do anything you can to keep your car. You don't want your car to get repossessed, right? So this uptick in auto loan delinquencies is worrisome because that really shows us how stressed consumers are. I mean, credit cards, okay, fine. Not the best that we're delinquent, but I can kind of kick that can down the road. Autos, if they come and repossess my car, I'm not going to be able to get to my job. So that's why we are seeing some stress in the lower tier of US consumers. One thing that's interesting is they actually have started doing cell phone receivables. So, if you purchase a new iPhone on a payment plan, iPhones are $1,000+ now, right? So it makes sense that you kind of can securitize that payment stream. We've actually seen phone device delinquencies increase. And I was like, wow, I mean, that's even more important to people than a car, right? So you don't want to give up your connection to your social media in your iPhone. So definitely seeing some pressure for consumers there. Now, we've shown you some of the concerns we have about the economy, but one thing where we have not really seen a deterioration in data is employment. So on the left-hand side of the chart, we have the unemployment rate and the 12-month average in the blue. And you can see, it is going up a little bit, just over 4%. It's really not at a level where the Federal Reserve is going to step in yet. Now, what we have seen, though, is a leading indicator that unemployment is likely to rise in the second half of this year. So on the right-hand side, we're showing the hiring rate and the jobless claims. So you haven't really seen, again, jobless claims moving up significantly, but the hiring rate, you can see a very strong trend downward, right? So that leads us to believe for now, with the uncertainty of the tariffs and everything that's happening, companies are likely not actively hiring, or if employees quit, they're not actively trying to replace right now, but they haven't taken the steps to actually do mass layoffs and things like that. I think a lot of corporations remember how tough it was in 2020 to actually attract workers. And so now, if things look like they might rebound more quickly, companies don't want to make that mistake in letting go workers now, only to have to pay, 3x, 4x to get them back in a few months. That is going to be the second critical metric is, the Federal Reserve has two mandates. One, to maintain price stability, so that's inflation. Two, to maintain full employment, so that's going to be related to the unemployment rate. So if you see the unemployment rate start getting closer to 5%, that is going to be a signal that the Federal Reserve is likely to step in and that the economy is slowing more meaningfully. That leads us to our 6-month macro scenario. And the good news is it looks a little bit worse than I think it should be in this 85% recession slowdown. It's actually only about a 35% chance of a mild recession and a 50% chance of kind of that soft landing, just slowing growth. So it's not saying we're going to be in an '08 scenario. We think that there's a slight risk if the Federal Reserve is very late to take action, if unemployment starts jumping and consumers really cut back on spending and GDP growth tanks, that would end up in the recession camp. But we think it would be pretty mild, and it wouldn't be very meaningful, even in that 35% chance. The soft landing scenario is really going to be that, 0 to 1.5% growth. So still positive, not a recession, but slow. So that's what we believe is the base case scenario. That's how we are making our decisions in our portfolio management process, is that kind of softer growth, but inflation starting to make its way back down to 2% more significantly. And we do have some small percentages in the elevated inflation scenario. So that would be the top two boxes: stagflation and growth surprise. We have about a 15% chance in those scenarios. Stagflation would basically be if the tariff policies get implemented at a more severe rate than the market's pricing right now. So that would lead to the higher inflation and the slower growth, because likely you would see companies start laying off people to save on costs, consumers would stop spending. That would kind of lead to the cycle of the stagflation. Growth surprise would be basically if the tariffs might not necessarily have such a negative effect. Maybe the tariffs kind of come in medium, a little softer than the market is pricing right now, and you kind of get a resurgence in consumer activity, right? And that's kind of what you've seen in the last couple of weeks, is people are kind of stockpiling in case of tariffs. I know I get emails every day from companies that I've purchased from being like, last chance to buy before we increase prices, buy now. We don't know what's going to happen. So they're trying to kind of lock in some spending before the uncertainty kicks in. So the growth surprise scenario would really be if people really continue to spend, inflation is sustained because demand is strong, but the economy grows on the upside because of that renewed spending. So that would be a bit of a very small risk, just about 5%. In that case, we don't think the Federal Reserve would reduce interest rates much further. In 95% of the case, we do believe, again, the Fed will cut likely at least 2 times this year. So I just wanted to end on this slide, just really reinforcing the message about what I shared at the beginning, is that fixed income is very attractive right now, not only just from an absolute yield perspective, but as we know, we are expecting more volatility coming out of the equity market, and bonds can provide diversification from that equity. So what we're looking at is the correlation between intermediate core bonds and the S&P 500. So you can see that, during periods of great stress, like dot-com bust, like right before and after '08, immediately in '08, correlations kind of rise towards 1 during extremes, but they quickly bounce back. You actually have a negative correlation between high quality bonds and stocks. So that's why when you're working with your advisors, that you generally will have some sort of fixed income allocation. And now you're actually getting paid really good yields to have that allocation in your portfolio. So I just wanted to end there, and I will take any questions people have about the macroeconomic content or fixed income or anything else that might be on people's minds.
Great. And just a reminder, anyone that has a question, you can feel free to throw that into the chat, or you can also email anyone here on the team or at info@raccoongroup.com with any questions that you have, and we'll be happy to answer those. So maybe, great presentation. Thank you so much. And I think when obviously we're always trying to take all that macro data and we're trying to use it to make decisions, right? And so I think from what it sounds like, you all are really favoring high quality in your bonds right now. Is that correct?
Yes. So there's a metric that we look at, and it's called spread over treasuries. So because US treasuries are seen as a risk-free asset, um, investors generally demand additional compensation to invest in things like corporate bonds or mortgages or any other securitized assets. And so right now, the spread that you're getting or the additional compensation you're getting to take credit risk is close to all-time tights. And given the uncertainty in the macroeconomic environment that we just talked about, we don't think you're being adequately compensated to take on a lot of junk bond risk right now. When you're getting, 5 to 6% yields in investment grade bonds, we think that that's a pretty good risk reward trade off. And it's not really an attractive time per se to be full on into high yield corporate bonds.
Yeah. So I think you mentioned it briefly in there, but when you're thinking about treasuries, right, and we have that kind of tempting scenario. We see 4% on the in short duration treasuries, right, and that feels like a pretty good place to go. Uh, but it sounds like maybe with where spreads are at on investment grade corporates, maybe we should be looking at something different from that.
Yes. So this is something that I have been talking to a lot of people about is that, post 2022, because you are getting, finally some yields in bonds, a lot of people started moving out of holding cash. And don't forget, we had that regional banking scare, right? So a lot of people took money out of their checking accounts and started putting it into money markets or CDs because you were finally getting something that was worthwhile. Pre 2022, you were getting maybe 1-2% in stuff like that. So now it's become rather attractive at 4. But I always like to look at the real return, right? So if inflation is still, closer to 3 than 2, 4 minus 3 is just 1% once you take away inflation. Maybe less attractive than we think. And with high quality investment grade corporate bonds, you can get closer to 6% yield. That's going to get you a lot closer to your goals than just staying in something like treasuries. And again, we don't see recession as a very big risk to the market. So it makes sense to us to take some well measured risk in terms of stepping out from treasuries to investment grade corporates.
That's great. So if we don't see recession risk in the near term, are we avoiding high yield just because the spreads are so tight and it doesn't feel worth it because of the risk? But if we don't have recession, then maybe is the risk lower, or we still just want to avoid high yield?
Yeah, and in our strategies, we will selectively buy high yield. So, we have some select issuers that we really like, that they have really strong credit stories, that we feel confident, or we think the market is mispricing their bonds. We will purchase those. We're actually eager to add. But when you buy, like, just the market in general, right? The index, that's what I'm going to say is less attractive just because you're getting a whole mix of things where you're not doing a lot of individual security analysis. You're kind of just getting, like, the whole load of whatever's out there in terms of junk bonds. And so, while there's some stories that we really like, there's some that we really don't. So that's why we're just a little bit cautious.
Well, that's helpful. And I know we've seen a lot more volatility in the 10-year treasury recently, which
Hmm.
hadn't been present for a long time, and we're experiencing now. And we're getting a lot of headline risk where it comes to the kind of the 10-year treasury. And then I mean, I think the big one we saw, right, was with the potential for the new budget bill and worries
Hmm.
over the budget deficit. I was just curious, is there a place where we really should be worrying in the bond markets about that budget deficit in the near, or is it really a longer term thing that we should be thinking, hey, this budget deficit's something we need to address?
Yeah, and that's why we've seen interest rates moving up in the last few weeks, is because of the fear of the increase to the deficit that this new spending package would increase. Now, a lot of people ask, okay, well, is it like a crisis? Like, is the US going to default on treasuries? Uh, I don't want to say never, but I think there's a 0.0001% chance that would ever happen. I mean, honestly, if the US defaulted on paying its treasury obligations, we have more important things to worry about than our
Yeah.
investments. I think I'm gonna have to go look for a cave in the woods to hide out in. I mean, it's so it would just cause so much turmoil in global financial markets. It just wouldn't happen. However, it is a concern that will have to be addressed over the intermediate to long term about the deficit to GDP ratio, right? Um, it's the second highest across developed markets. Japan has us beat. But until there is a more long-term credible alternative to treasuries in the US dollar, there will always be buyers for treasuries, right? One common question I get is, oh, are foreign governments cutting back on purchases because of the trade wars and the rhetoric that Trump has unleashed across our global trade partners? And the answer is actually no, with the exception of China. But China's been cutting back their treasury purchases since the first round of the trade wars in 2018. So we have actually not seen a reduction in the purchase of treasuries by foreign buyers. In fact, right now we are at the highest level of treasury holdings by other countries than we've been in a long time. So that is not something to worry about in the short term. In the long term, could things like Bitcoin take over the US dollar as the reserve currency of the world? I mean, possibly, but that's going to take decades to play out. So, in the short term, for us, hopefully it won't cause too much disruption over the next, even 5 to 10 years.
We're getting Bitcoin in our bond conversation. That's always good. So sprinkle some in there. I think that's great. So are there other areas of the bond market maybe that we don't think about? I think about, is it something like preferred equity? Is it the private credit markets? Are there areas maybe that is it just a diversification strategy we need to be looking at these, or are they areas that you guys are actively kind of pursuing?
Yeah, I mean, there are teams at American Century that manage like preferred strategies. I definitely think there's some value to them. They are also very attractive yield opportunities and things like preferreds. They tend to be less correlated to both stocks and bonds. So it's like I think adding alternative investments could definitely make sense just to lower the correlations to these more traditional instruments. However, with things like private investments, you are getting potentially higher returns in yield for a liquidity premium. There's no free lunch, right? So you're going to pay something. And that's also, we haven't seen private credit and things like that stress tested through things like '08. We don't know how they would react in a extreme market environment. So, you know,
Yeah, it's
I
it's
think
an
there's
introduction of another type of risk to the portfolio,
it's a
right?
different risk, right? It's just
Yeah.
what types of risk are you just have to understand the kind of risk you're taking and then make the judgment if the yield you're getting is fair.
Hmm. Great, thank you. I was curious, are we seeing any changes just to kind of non-government debt issuance? right? Where we've kind of been sitting on our hands waiting for some bigger rate cuts for a while. And if I were a company, I'd keep saying, hey, I'll wait till rates get lower before I issue new bonds. Have we seen impacts like that? Does it make it harder to buy and trade in the bond markets, or has it been pretty steady?
It's still been pretty steady. We have seen so peak issuance was happening like a few years ago. A company like individuals, I think everyone who could refinance their mortgage at like historically low rates, companies did the same, right? Like they took the opportunity to issue bonds at rates that they were never able to issue at before. Even companies like Apple, they have $1 billion in cash on their balance sheet. They went to the market post COVID to lock in basically free money, right? Considering inflation was running 5-6%, if you're issuing bonds for two, you're basically capturing some free money there from the market. So we have seen a drop in issuance, but it's still relatively very strong. There's no liquidity concerns or anything we've seen there.
Great, great. Well, I think we're approaching here about 45 minutes. Any last thoughts you want to send us away with, or we can close it out there, not to put you on the spot, but you seem to do fine with it. So
Yeah, no, I just wanted to just remind everyone that, I think recency bias is a big hindrance to people's success in terms of investing. So frequently people are like, oh, bonds. Yeah, I was down big in bonds in 2022. Like, I just want to stay in cash. But they don't think about the fact that in terms of what's going to be best potentially going forward is not sitting in cash and reinvesting your money, right? So I always like to say it's not timing the market, it's time in the market. Over time, as we saw in that last chart, bonds can provide some really nice negative correlation to equities. It can soften some of the volatility in your portfolio. And now we are seeing some pretty compelling yields.
that's really great. Thank you so much. And thank you everyone who could join us today. If you have any further questions, please feel free to send them over to us. I'm sure Joyce and her team would always be happy to answer any additional questions that we didn't get to today. But once again, thank you so much, and we look forward to the next conversation.
Thank you. Have a great day.